Hello and welcome. Tom Daly here from the Academy of Financial Trading, and we are about to begin your fourth lesson as part of your foundation trading program. This evening's lesson is one of our own favorite lessons whereby we're going to start looking at charts. We're going to try to find ways where we can understand what is happening and where opportunities might actually present themselves. We're going to also discuss areas where people are highly indecisive, where they don't know what might happen next, and where we can position ourselves maybe to have multiple potential trades going into the market. So this evening's lesson is going to be very exciting, it's going to be very enjoyable, and we will begin this and every lesson, as you can see on the screen in front of you now, with our risk warning. Obviously, we aim to help you to understand what risk is and how best to manage it. When we talk about technical analysis, actually, you know what, just before we start into it, guys, if you don't mind, I just want to do a quick sound check, just to make sure everything is coming through loud and clear. If you can just type in yes or Y or something affirmative, something in the positive anyway, so I can just relax a little bit to make sure that everybody can hear me coming through loud and clear. Okay, brilliant stuff, guys. Brilliant stuff. Great to see. Great to see. Okay, so what we're going to do, obviously, this evening is we're going to look at technical analysis. And this technical analysis, what we do is we use it as a way to find opportunities in the market. You can use it also as a way to get out of trades in the market and of managing risk. Now, in this webinar, there's probably a pretty even split as to those who have traded and those who are totally new to trading. So maybe let's speak to those who have traded before for just one moment. Have you guys, those who have experience, have you ever been in a trade, been in a particular stock, in a position, in a particular stock, and you've found your way into it for whatever reason? You've watched yourself gather large gains, you got a good profit, and then you just saw them disappear when the price started to fall, when the object started to fall. You didn't know how to actually get out of that position. Has that ever happened to anyone on this webinar? Has that ever happened to you guys? Ian, I can see yes, absolutely. Lohita, Vanessa, Ahmed, Kevin, Jackson, Ross, Vida, Alistair, Weston a few times. Yeah, absolutely. It's a story for those who have ever traded. It does happen far too often. And throughout my own career, I've watched it happen to many, many different people. They find a trade, they get into a position, it makes them money, and it's almost as if you remembered the good times. You remembered when that position was making you profits. You sit and you hope for it to go back up. You see, that's incredibly dangerous. But if we are using technical analysis, if we are simply measuring what the market is doing, well then, if you're following a position and if you're adjusting your stop loss and protecting your profit into the market, if it falls down, you've got an objective way out. So even if you don't like that type of approach, which we find is best for looking for entries, well, at least pay attention maybe for this section when we're talking about exits. And let's talk about this a little further. We feel that this can be a totally independent heading, separate from absolutely everything else. And the reason why we say that is that it makes profit for us. It really is that simple. We do not like fundamental analysis when it comes to trading. We don't like it because what's good and what's bad is a very difficult question to answer. We don't like fundamental analysis because of the fact that we don't have a crystal ball. We don't have access to a DeLorean. We also say that hybrids, unless they're a type of vehicle, they're pretty dangerous. A hybrid is a mixture of two different types of things. In natural sciences, they're often quite dangerous, and in financial trading, they're also quite dangerous. So what we're talking about here is the type of trading where you look at charts a little bit, where you look at newspapers a little bit, and basically by the end of it all, you've no real idea as to what you're doing. That's what a hybrid is, a combination of lots of different things. Now we know that just about every educator out there likes hybrids, and the reason why is because they feel that they can never be wrong. Okay? We're going to just focus on quantifiable objects, on what exactly we can measure. And Andrew, I see you're asking, what is a DeLorean? Andrew, I feel like I'm showing my age a little bit. If you remember the movie Back to the Future, Michael J. Fox, a legend of a movie in its own time. There was a car called a DeLorean which allowed you to travel back to the future. So that's what I'm talking about there. A little abstract, I'll give you, but we'll continue on. So let's define technical analysis. Technical analysis is the study of price action. And what we're trying to do is measure what has happened as a way of gauging what is likely to happen. So we're measuring the past in order to prepare ourselves for the future. And it's based on the idea that history repeats itself. And what we're going to do is we're going to use charts as our interpretive devices. Or more importantly, we're going to use Japanese candlesticks. And when we look at technical analysis, guys, unfortunately, I guess we at the Academy of Financial Trading, we did not invent technical analysis. Fortunately for us, from a competitive perspective, nor did any living person on this planet. You see, we've used technical analysis for as long as we've engaged with one another from a commercial perspective. And maybe let's explain that a little bit more. Let's say when mankind or when human beings started trading agricultural products for pieces of metal or pieces of machinery or something along those lines, they would have remembered what price they had achieved last season or last year, over the last decade. That remembering of price action, you could say that that is actually technical analysis. What we try to do is measure it much more efficiently, in real time. So what is the basis of technical analysis? Who can help us a little bit? Why would that be a good way of operating? Or what would be the premise upon which it's built, guys? Why would measuring price be a good idea when we're looking at financial markets? What do you think, guys? Type in your answer. Absolutely, Eileen. It allows you to predict. Ian, dead right. No emotion involved. Christina, looking at cycles. Absolutely. Dominator, reference. Jackson, history repeats itself. Hussein, see trends. Lohita, also history repeats itself. That's absolutely right, guys. All of those answers are absolutely perfect explanations. And there is one further one. And it is something which very few of us like to admit. We, as human beings, by our very nature, we are repetitive. All you've got to do is ask someone close to you, someone who loves you, someone who cares about you, somebody who's not afraid to tell you the truth. Do you have any bad habits which you repeat? And I'm sure there are some people in your life who will tell you every bad habit which you repeat. But we all have them. We all have habits. We all have characteristics, and they're quite difficult to change. And why is this important? You see, when you look at financial trading, people make and lose money every single day. Let's take a moment to think about this conceptually. People make and lose money every single day. And when we make or lose money, we become somewhat more predictable. Okay? Let's imagine a scenario. Let's use a bit of an analogy. Again, we'll go back to our cars. Okay, for all those people who are into their vehicles. Okay? So let's say that you had just purchased the vehicle of your dreams. A car which you had absolutely been living for, been yearning for months or years, and had been waiting, had been working very, very hard for it. You get into that vehicle, you hear its engine start, you drive out of the garage, you come out of the forecourt, you drive it home, you come up and you park the car in your driveway or in your apartment block or wherever. And straight away you hear the most unnatural, the most disgusting of noises. That is a metal object ripping against the side panels of your car. Not one panel, not one wing, not one door, but all down the side of your car. You get out. It's not just your paintwork. It's gone right beyond into the actual metal of the car. Guys, how would you feel at that exact instance? You're standing there, you're looking at the car, you can see the extent of the damage which is being done, and you've just about to show your loved ones, your friends, your family, this beautiful car that you've been working towards. Absolutely, Ferentia, I would feel the same. Robert, absolutely right. Kevin, I like the way you type. Absolutely. Zubair, you're dead right. Dominator, very angry. Absolutely. Guys, there are a lot of words coming in that I would definitely say, I would definitely feel, were it not for the lack of an age limit on this webinar. You'd be upset. Let's just say it like that. You'd be frustrated. You'd be annoyed. And what is that feeling? That feeling in your stomach. That feeling, is it a feeling of loss, of embarrassment, of financial loss, of opportunity cost, of disappointment? All of these human emotions, a churning feeling. And let's think about this a little more. Imagine the exact same instant had happened to you 1 year ago with the then vehicle that you most desired. And at that exact instant 1 year ago, if we had asked you the same question again, would you have felt similarly, guys? Just a Y for yes, or an N for no is fine. At the exact same snapshot in time, with the exact same desires for the object, would you have felt similarly? Absolutely, of course you would. And why is that, guys? It's because when we make or lose money, whether it's today or yesterday or last week, at that exact instant we become repetitive. We are human. We feel loss. We remember it. And what technical analysis tries to do is to find when people have that feeling, to find when people have that understanding, I guess, of success, or have even that understanding of failure. So the issue here is that technical analysis can provide us with a much clearer cut approach with much greater objectivity, and that is what we need to use when we're trading, when people make money and when people lose money. Now, the fundamental analyst, they try to predict the fair market value. They look at the object and they look at the balance sheet and they look at the price to earnings ratio and they look at the cost of distribution. They look at the unit sales from particular regions, and then they finish up and they say that they think that everybody else in the market is wrong and that object is either under or overvalued. Everybody's got it wrong. They value it differently. That ignores the idea that markets are efficient, that they actually factor in change in real time. But the technical analysts, what they do is they simply look at the object and they try to measure what it is doing. They try to find an opportunity based upon the same. So it gives us much greater objectivity. It's much easier for those who are new to trading to actually perform. So what we're going to try and do is a process which we call see, accept and trade. SAT. We're going to look at what's on the chart, we're going to accept what it is actually doing, and we're going to trade accordingly, provided we have confirmation. And confirmation is going to be like a positive signal telling us that a trade exists. So let's look at this a little further. What we must be conscious of is that we're at the starting point of your journey. We are learning what all of these individual factors are. And over and above that, we must combine them together. So this evening is a starting point of technical analysis. And when we're talking about technical analysis, one of the main tools which we are going to use, like we already mentioned, is Japanese candlesticks. And we're going to go into a lot of detail about Japanese candlesticks in just a few moments. And then we're going to look at indicators. And there are a huge amount of indicators. There are a huge amount of people who think that they can trade. And those who can trade make profits. Those who cannot trade, unfortunately, they consistently lose. So what we're going to look at is how to identify those losing traders. So let's put everything in context. Most people focus on a trading edge, on the holy grail of trading, on understanding something which nobody else understands. But in just about any other area of business or any other area of sport even, it is very useful to understand your opponent. And what we focus on exclusively is exactly that. How to identify when people might behave predictably. So let's look at this further. Let's talk about what the candlesticks represent in order to show whether buyers or sellers are winning the battle. Let's not overcomplicate things, because the names which most of the candlesticks are called, I guess they're quite unusual, but the names themselves are absolutely unimportant. Okay? What we want to find is who is winning or who is losing a particular battle. Now there are 4 crucial pieces of information which every single candlestick tells us. Who can help us out? Who can tell us what those 4 key pieces of information are? What are the 4 key pieces of information which every single candlestick tells us? What do you guys think? What are the 4 key pieces of information? Every single candlestick contains them, guys. Type in what you feel the 4 key pieces of information are. Great stuff, guys. Great interaction this evening. Every candlestick, it must start somewhere. It must begin. It must be born. So you have an open price. And then every single candlestick must come to an end. It must close somewhere. So that's the second point. So you've got the first point is the open price. And the second point is the close price. The third point would be the high point of the day. And the fourth would be the low price of the day. So they are the 4 key pieces of information. And on the screen in front of you now, you can see a green candlestick. And what you've got is the open price. Let me just change the color of my pen there just for 1 second. So if we imagine the open price is at that $100 mark. Right there at the bottom of the body of the candlestick. That is the open price. And it's true asking these questions, guys, that you're going to genuinely grasp all of these concepts. So can everybody see that? Can everybody see that open price? And can everybody understand as to why it's down at that level? Brilliant stuff, guys. So what happens after the open price? Maybe the market goes down a little bit. Maybe it goes down to that $80 mark. Okay? But then the bulls come back out and they gain strength and they press forward and they bring the market all the way up to that high point, we'll say at 220. But they're not strong enough to hold the market there, so it sells off ever so slightly and it closes at the end of the day at, let's say, 200. So can you tell me who won that particular battle, guys? Who won that particular battle on that particular day? Did the buyers win or did the sellers win? Did the bulls win or did the bears win? Did the longs win or did the shorts win? Which one actually won the war in this instance? Who gained territory? Who brought the market in a particular direction? Did the buyers or the sellers win that particular war? Look, the buyers obviously won. They pressed forward. They took territory. The close price is above the open price. So those who were long the market, those who were buying the market, those who were optimistic on the market price, those who were bullish in the market, it's the same way of saying all different scenarios. They are the ones who won that particular battle. So let's check out a red candlestick. On this candlestick, we can see the market opened, let's say, at the 200 level. At one point, the bulls went up to 210. And then they brought the market down to maybe 80. And they finished up at, we'll call it 90. Can we all agree that in this scenario that the bears won the battle? Excuse me, the low point was 90 and the close price was 100. Can you all see that the bears won that battle? They were offering lower prices. They pushed forward. They gained ground. So those with a pessimistic view on the market, those who were bearish, those who sold the market, or those who were short the market, they won this particular battle. And we know they won because the close price is below the open price. It's at the lower end of the range. So there we have it. So we're going to use these candlesticks and some similar to it in order to find opportunities, in order to find ways in and out of the market. Let's go and examine a chart. Let's have a look at this Barclays chart. And we can see the price on the right hand side of this chart. Okay, we can see what's going on here. Okay, and on this Barclays chart, what you can see is that it's really meandering, isn't it? It's going up and down, and up a little higher and down, and up a little bit more. And it's really just meandering up and down. Nobody really winning in the longer term. Okay? But if we asked you, did you favor a long or did you favor a short in this position? Who was winning? Do you think it's more likely to rise from where it is now, or do you think it's more likely to fall from where it is now? But before you jump in, would you like to say that you'd like to see a little bit more information, maybe to put it into a bit of context? And when you put it into context, you can see that Barclays in the longer term is in a slightly downtrending channel, isn't it? You can see every high is a little lower than the previous high. Every low is a little lower than the previous low. So what this larger picture shows us is that the direction is indeed down, isn't it? And you can see that there is an area on the top side where I've drawn this line at X. And we'll call it a barrier to the top side. And again, the second line which I've drawn to the downside, we'll call that Y. We'll call that a supportive area or a floor. And this is something we're going to get into a lot more detail in over the coming classes. But you can see that Barclays is operating in quite an interesting way. It's range bound by this kind of bottleneck formation almost. This downtrending channel. Everybody is tied up within that formation. And what we might be looking for is we might be waiting for it to either break out above the X line or to break down below the Y line. And if it does either one of those, it would provide us with an opportunity. It would provide us with a bit of confirmation, I guess, that we might consider an entry. So let's go and look at this further. What we're talking about is Japanese candlesticks showing the previous price action. And just because they are showing the past and nothing but the past, they are indisputable. They do not lie because they do not attempt to predict. So what we now need to look at is some more patterns. Can anybody on the webinar, can you tell me some patterns that you might have heard of when speaking about Japanese candlesticks? If anybody's used these sorts of charts before, Johannes, I can see that you have it absolutely. Has anybody know any types of patterns? Okay, look, the first type of pattern which we're going to look at is called a doji. And all of this all that it represents is absolute indecision. Can you see why it represents indecision? You have an open price and a closed price at the exact same level. The market opened at 100 and it closed at 100. Okay? It might have gone up to a high point. It might have reached up and it might have gone up as far as maybe 120. So we have a high point right up here at the top. And we can say that that's the 120 level. Okay? And it at some point during the day, it also went down to a low point. And we'll call the low point, just for sake of argument, the $80 mark. But can you see that neither the bulls nor the bears won that particular war? Can you see that there was no clear winner in this exact scenario? And it just shows that there was absolute indecision. There was nobody who was confident enough to take the upper hand. There was nobody who had that absolute confidence that they were going to win, whether it was the bull or the bear. The bull or the bear, excuse me. And what that can do, this indecision, this can present you with a potential opportunity. Because what you know is that when the market breaks in one way or the other, that you will find opportunities as a result of that. So you might say, that this candlestick, it might be better off calling it a spotlight or a magnifying glass, telling you to pay attention. Because if it goes above the highs of 120, you might look at longs. If it goes below the lows of 80, you might look at shorts. And can you all see that? And what we say is by no means, or not by any means, is giving us enough information to actually risk our cash. But it is a piece of confirmation if the market actually does that. It's a piece of supporting evidence if the market tells us that it's going in a particular direction. It's just supporting evidence. And let's look at this on some older charts. And we're going to work our way right through to newer charts and showing you the significance. Can you see the top of this market, okay, where you have relative indecision within this circle? And then the market reverses. And the same at the bottom. And then in that bottleneck on the right hand side, you have that same thing happening again and again and again. And some of these candlesticks, they have got very, very small bodies. They've got very small bodies themselves. Can you see that? Can you see that there's no real body, whether it's green or it's red? So it shows that there is indecision. Can you see that there is no body? There is a tail or a wick to the top side and a tail to the bottom side, but there is no real body to it. And that is the type of thing that we're looking at. It's that kind of indecision in the market. It's telling us that neither the bulls nor the bears are massively confident as to what is going on. So it allows for opportunity. And it's something which we're going to look at much more as we progress. But in each instance, we classify these as dojis because what they represent is still indecision. They represent in each instance that the market is simply indecisive. It's not sure as to what direction it's going to take. So what we're going to look at is, why did we catch an opportunity below this area now? I'm going to show you right here. Below that red line of S. Could we take an opportunity there? And I feel obviously we could. And we could say that there is a line up here. We're going to call that R. So again, to the top side we have resistance. To the lower side we have support. And we can see the closer it gets to the apex of this wedge, we can see the more indecisive it comes. That more of these doji are actually appearing. But we can also see that when it breaks, there is a substantial move. Can you see how large that red candlestick appears to be after an actual decision has been made? After one side of the market gains confidence? Can you all see what is going on there? Great stuff, guys. And let's look at a current chart. Or, well, a more current chart anyway. Let's look at this gold chart. Oh, excuse me, it's not a gold chart, excuse me, it's a Facebook chart. And we can see again here, right at the very top of the market on the right hand side, you can see exactly what's going on. Okay, so you can see indecision. Okay, and you can see there was time before that where the bulls had taken charge of the market. They had pushed it right up. And they'd reached a level where they were now indecisive as to whether or not they should press their advantage even further. Perhaps they were happy with the move that they had made. It was coming in around about that 10%, or maybe just over 10% of a move from the lower end of the range. So perhaps that's all they were looking for. They were looking for a 10% profit. And when they were unsure, this doji appeared. They were no longer strong enough to push the market any higher. So it fell back down again, didn't it? And that's a signal for us. That's an opportunity for us. It's something which we need to be aware of in order to give us an entry signal. It's not absolute out and out confirmation, but it is a little tick. It's a piece of supporting evidence which we might consider. Can you all see that, guys? Can you see that type of formation? Brilliant stuff, guys. Brilliant stuff. And another type of candlestick. Now we're going to be going through quite a few different types of candlesticks, and they all have their own individual names. Okay, they all have their own individual names. I will say to you again to not get hung up on each individual name. What they will mean in each instance is that a trend is looking for a possible reversal, or as just overall indecisiveness in the market. And that's all we need to be concerned about. As I explained already, it's a bit like a magnifying glass. It's a bit like a spotlight. All we want to do is to start training your eye to see exactly what is happening in the market, so that when you're looking at a chart, it'll begin to make sense to you. And it'll begin to make a lot more sense then as we progress. No trouble at all, Jeff. No trouble at all. You're very welcome. Okay, so let's look at this next type of doji. This is a larger form of doji. It's simply called a long-legged doji. It's almost like exaggerated indecision. And a lot of people would like to combine this with fundamental analysis. And the reason why is because we have an insatiable appetite, an insatiable curiosity for the word why. And by the time those traders find out why a market has moved, they simply miss an opportunity. They miss the opportunity. Okay, so let's look at this further. Let's look at this in a platinum chart. Can anybody see where the long-legged opportunity is on this chart? Could you identify the approximate date at which it happened? And remember, a long is a market which moved up. You've purchased it and it moved up. A short is where you've speculated on a fall in the market. But can anybody spot this long-legged doji? Absolutely brilliant, guys. The vast majority have got it. Can everybody see that vast amount of indecision on the right-hand side? And you could look at it and say, you know what, it's hocus pocus. It means nothing. It's just a candlestick. It's not really. It's actually people. Because people sold and sold and sold and sold, and then they changed their mind. They didn't feel that the market would be justified to remain down at that lower point. And now, okay, you can say hindsight is great. We can now clearly see that there was a turning point right there because of the progress the market has made since. And we can also look back a little bit into history, and we can say that that level has proven itself before, and we'll say that at that period of X, it's proved itself back then as a level where the bears could not push the market down any further. So we have possibly two pieces of supporting evidence. It turned twice at that area. And then the third piece of information might be that long-legged doji itself. So you have what we call a double bottom, and you have a long-legged doji. So you have three pieces of information which give you an opportunity to potentially go long in that market. Does that make sense, guys? And again, we do need more pieces of information. We do need more pieces of confirmation. But this is what this market is showing us right here, right now, at this point in time. And maybe just to explain it an ever so slightly bit further, okay? So if I just take out my pen here, I'm going to label these candlesticks. So this first one here, this small one is number 1, the second one here is number 2, and the long-legged doji itself, we're going to call it number 3. Okay, and remember I've said that this might be a candlestick, but what it really represents are people. This is the action of traders in the market. And after day 1, there was a sell-off. We have a red candlestick. So the open was lower than the close was lower than the open. And what it tells us is that the bears pushed the market down, and when they reached its lower levels, they were happy, they were content, they were confident they didn't have to realize profits, and they were happy in the knowledge that they felt the market was going to push down further the following day. And what happened on day number 2? There was a substantial sell-off, and the market sold off a lot. And it reached down to the lower end of the days, and the bulls were so confident that they stayed right down at those lowest levels. So can you see how confident the bears were? They had sold and sold and sold and sold and pushed the market further down and further down and further down. And then at the end of the day, they were quite content to stay down at those lower levels. They felt that they were emboldened. They didn't have to realize profits. They felt that they certainly had the upper hand in the market. And on day 3, what happened? They pushed the market all the way down again, right down to those levels. But instead, what happened this time was that they lacked the confidence to stay there. They did not have the same confidence as they had on day number 2. So they realized their profits. And some of the bulls then maybe saw that as a sign of weakness, and they pushed the market higher. And the market closed at the pretty much same level as it had opened at. And can you see how nerve-wracking that would have been for a potential bear? Can you see those who were short the market would look at something like that and say, gosh, maybe we've got it wrong. Why didn't we have the confidence to push the market below that 1680 level? Why didn't we think it was going to fall further? If you don't have the confidence to maintain a low, then the obvious thing is that the potential exists for the market to reverse, to turn around, and to move in the opposite direction. Can you see that, guys? Does that make sense? Does that kind of formation now make a little more sense? Great stuff, guys. Brilliant stuff, Alistair, Robert, Melanie. Great to see. Okay, so the next type of formation is a gravestone doji. And you're also going to see a dragonfly doji. And again, what these represent is indecision. Okay? And the other candlesticks, they were pretty much 50-50 in terms of what they meant, whether it's up or whether it's down. But these ones, they represent indecision, but you would say that it's more likely to see a reversal than a continuation. So how do we put that another way? In a falling market, if this appeared at the bottom, you would expect the market to rise. But you would still consider two trades. You'd still look at both longs and shorts. But you might allocate a larger amount of risk to the long side if it was a falling market. And the reason why is because there is more supporting evidence in that direction. And let's say you were going to risk 1% per trade. The top one could be 1%. The bottom one you might risk less. You might risk a half of 1%. And during the 9th lesson, we're going to talk about this in much further. But in a rising market, you might expect a drop more than a continual rise. So let's look at this. Let's look at this BP chart. Can everybody see that BP chart? In BP, you can see that the market had gone up. The market had gone up. And you had this candlestick which opened within that circle. Okay? All the way there. You can see that candlestick. And then it pushed all the way down. If that wasn't giving you enough evidence of a reversal, it showed you the indecision. And the market sold off very heavily over the short term. So it's showing you where there is pressure. What we also talk about is a dragonfly formation, which is an upside down gravestone. And let's look at this on a chart. Here we can see 2 points where it showed us possible reversals. Can everybody see that, guys? Again, I don't want you to be worried about the names. The names are insignificant. I just want you to be aware that it shines a spotlight on the market for you. It shows you an area where a potential to reverse exists. That's all it is doing, okay? It's showing you the potential for a change. And then let's talk about a hammer or a hanging man. It's called a hammer if you see it in a downtrend, and it's called a hanging man if you see it in an uptrend, okay? So there's different names again, which to my mind are absolutely inconsequential. They're insignificant. If you're totally new to trading, you might need to watch this class again. And as well as that, we're always working from the oldest data point to the newest data point. But let's check out this hammer. The reason why it's called a hammer, I guess it looks like a very crudely drawn hammer, doesn't it? And if the market was to fall, and if you saw this appear, you would say that it's likely to hammer out a bottom and bounce back up. You might say that there are 2 pieces of information for a long versus 1 for a short. And the reason why you would still place both pending orders is because past performance is never a guarantee of the future. So you would always, when you see a period of indecision, when you see something appear like this on a chart, we would still always place orders in both directions to make sure that we're able to avail of the subsequent opportunity irrespective of the direction. But if this hammer was to appear in a downtrend, we would favor a long. So we possibly would risk more taking a long position than we would a short. But again, the risk side of things is something which we're going to go into in much more detail, particularly during lesson 9 later in this webinar series. So what you do is you simply cover off either eventuality. And the trick here is that your risk management is what is going to generate your profit for you. But you have both sides of the trade covered. Okay? And then we talk about a trade or a trend in Aussie US dollar. Can you all see those hammers, those hanging men in the market? Can you all see those? I'll take out this spotlight again. You can see down here at the lower end that the hammer literally hammered out the bottom of the market. And then the market did not go lower than that. Can you see that? Can you see it hammering out the bottom side of that particular market? It came back down and maybe gave a slight retest. It didn't reach as low, but it pushed on up for it. So it gave us a signal, and what we do is we see it, we accept it, and we trade it absolutely objectively. We don't go around asking why is it doing it, what is going on in the Australian economy or anything else. We just look for opportunities. Now let's look at a more up-to-date chart, I guess, in Aussie US dollar. And right now it's looking very interesting because it's essentially operating, within that range over on the right-hand side, isn't it? And what we might do is we might look for shorts if it breaches down through that line. And we might look for longs if it reaches above that line. So we see these doji, we see these as spotlights, we see these as areas of interest. These catch our eye and we're then able to trade accordingly. And even if you scan your eye across this chart from left to right, you can see these doji appearing again and again and again, particularly in times of reversal. And you can see how you would now react. The trouble which most people have is that they're always waiting maybe a little bit too long, that they're fearful of applying their capital to the market. But we feel, I guess, when you're fully knowledgeable, when you are fully aware of the risks associated, when you have a full risk management procedure in place, which is something we're going to cover again in lesson number 9, then you should have nothing to fear when it comes to the market. So, long and short, Brent. L stands for long and S stands for short. And Robert, I absolutely agree with you in that instance as well. And we'll show you why, I guess. Yeah, Robert is just saying that it's a lot lower now. And absolutely. But we'll show you why it is, to be honest with you. I want to show you as we progress exactly why. And especially in class number 5 and class number 6, where we're going to be going into descending triangles, which is exactly what formed here. A descending triangle. And why descending triangles, again, what they tend to do is they tend to favor the lower side of things, Brent. They sure do. They sure do. Okay, so that's something which, again, we're going to look at in much more detail as we progress. So let's look at GBP, JPY. Can everybody see those hammers and those hanging men? And if we look at that same chart, there are also a lot of other useful indicators. Can you see those long-legged dojis on the left? Can you see those hammers on the right? So there's always things for you to look at in a market. They've got, I'm just going to zoom in here a little bit more. Can you see even in this particular area here, can you see the amount of indecision created in that market? Can anybody tell me the types of formations that they see? Particularly here and here and here and even here. All of these areas of indecision and all at this top level, isn't it? And what happened after it? There was a strong move down, wasn't there? And that is the type of thing which we're going to be looking at as we progress through this technical analysis section. So you can see when the market gets range bound like this, where you have this resistance to the top side, where you have this support to the lower side, that it does become range bound. And what we look for is a break outside of this range. So we're going to be, again, covering these topics in a lot more detail as we progress. And it's important that over time you get familiar with charts. You get familiar with reading them. Much like a book, always from left to right, and you just follow the price and see exactly what is happening. Okay? All that happened in this particular chart is that buyers were offering higher prices to start with. And then there was this maybe period of consolidation. They were indecisive as to whether or not it was going to continue. But rather than wondering why they stopped, why don't we just ask ourselves, what are people actually doing with their trading? And for an extended period of time, they literally opened and closed at approximately the same level, didn't they? And that's exactly what we see in the chart. They're being indecisive. And after that, there was a breakdown. And after that breakdown, then the market pushed higher once more. So it's these areas of consolidation. These are always the areas which really draws our mind to a particular chart. They're the points where we always have interest, okay? So these are the things that you're going to get used to watching, okay? Now, the next formation is simply a reversal of what we've gone through. It's an inverted hammer. An inverted hammer. It's an upside down hammer. It's called a shooting star if it's in an uptrend and an inverted hammer in a downtrend. And it simply means that a reversal may be coming. If we look at crude, can everybody see these formations? Again, what we want to do is simply train your eye to spot these types of formations so that you can see them occurring on a chart. And that's what is important to us. It's important that you look at a chart and you begin to be able to read it, to begin to be able to spot these opportunities, to look back in time and to see exactly what happened when these dojis presented themselves previously. And it'll give you a great idea as to what they might be doing if one is to appear again in the future. So, with all of these candlesticks, they're highly important, but these next ones are our favorite types of candlesticks. They're powerful, they're strong, they're clear for you to see. And let's talk about these. We have on the left-hand side, and we have more on the right-hand side. On the left-hand side, over the course of 6 days, the bears brought the market down. Can everybody see that? It took them 6 days to travel that distance. But over the course of just 1 day, The bulls came out and they absolutely annihilated those 6 days of strength from the bears. They brought the market up higher. They engulfed them. They took over. They gained so much territory. Does everybody see that? They gained so much territory, they burst through the defensive lines of the bears. So the bulls must have won that battle because they annihilated the bears. On the right hand side you also have 6 days, but in this instance the bulls went so much further than just beating them. If we could all agree that this is indeed a bullish pattern, would you say that the left or the right is more bullish? Now don't second guess it, just see it, accept it and trade it. Do you think that the left or the right is the more bullish? Which one travelled a greater distance? Who was more powerful? Who scored more goals? Who gained more points? Absolutely, it's got to be the right. It's got to be the right. So we have a signal. If we see that, we see it's confirmation. It's more bullish. Let's check it out on the chart. And what we're going to do is on this chart, we're going to ask you to find them. Again, work the chart from the left to the right. Can you tell me where the bullish engulfing patterns are? There are several of them. There are quite a few on this chart. Can you tell me where they are? Can you tell me where they are, guys? Those bullish engulfing patterns. Absolutely, guys. Well done. The largest are in the red circles. It keeps telling us of the strength which is gathering, and it takes off. We have another one here. We have another one over here. And if you were trading something like Barclays, you would have seen this trade coming from the bottom right-hand corner. Can everybody see that bullish engulfing pattern on the bottom right-hand corner? Have you ever been trading an equity, guys, and on one particular day it just takes off for no apparent reason? Just takes off in a particular direction and you scramble around to try and find out why. Has that ever happened, Annie? When you go onto Google, you search everything about them and you ask, why is it doing that? What is happening to my position? What is happening to that share? Did you ever stop and think, okay, what if you had stopped Googling? What if you just said the market is moving with force in a particular direction? It's like a train setting out on a set of tracks with so much force and momentum. What if you just went with it? You could have captured a movement. So we see it, we accept it, and we trade it. And that's what we are looking to do. Then we're looking at Aussie US dollar. Again, a more recent one. And again, we could say that it was engulfing back then. It was engulfing, a bullish engulfing pattern. Okay, you can see it right there at the end of the chart on the right hand side. You've got what, 1, 2, 3, 4, 5, 6, 7 days of trading that was just taken out by one bullish movement. Okay, so that is exactly what we're looking at. We have another one right here, don't we? We have another one right there. And that is huge strength being displayed. And then, obviously, just like we have a bullish engulfing pattern, we also have a bearish engulfing pattern. Okay? The bears have come out and they've crushed the bulls in this instance. They have crushed the bulls. On the left-hand side, they took 2 days. On the right-hand side, they took 7 days. Who is the more bearish, guys? Where does the more strength lie? Out of these two sides, which one is better? Which one is stronger? Which move is stronger? Absolutely, guys. Absolutely. The one on the right is a lot stronger, isn't it? It's got to be the right-hand side, because on the right-hand side, the bulls didn't just win. They absolutely annihilated. Excuse me, the bears didn't just win. They absolutely crushed the bulls. The bulls were left looking in the mirrors at home, asking themselves, is that really the life that they want? Going about pretending to be bullish. The bears absolutely killed them. They annihilated them. Therefore, we want to work with the most dominant party in the market. Now on the screen in front of you now you will see a gold chart. Many people had been buying gold. It was clearly overcooked because so many people wanted it. Now let's talk about this. In this gold chart there is a nice bearish engulfing pattern. But there is a much better pattern on this screen somewhere. Can you find that pattern? There is a massive bearish engulfing pattern, one of the biggest of the entire year. Fatima, absolutely right. The bears absolutely crushed the bulls. Deborah, you're right as well. Hussein, absolutely. And it started one of the biggest ever declines in gold, which still people refuse to believe that it is happening. The bears killed them. The bears crushed them. And who knows what the price of gold is now today. And bear in mind that at this point in time it was up at that $1850 or $1750 to $1800 level. What's the price of gold right now, guys? What is the price of gold right now? Does anybody know? Who knows what the price of gold is today? Absolutely, it's down around that 1180 level. Okay? And the issue is that this is an example which we took from that exact date. Can everybody see that? We took it from that exact date. And we showed people the massive engulfing pattern. And those who were able to see it, to accept it, to trade it, they caught it. Those who didn't, they would have literally lost their shirts because it was a massive decline. And now you're probably thinking, well, throughout this evening's webinar, we've been talking about the past. And you know what? We pretty much have. But let's look at a more recent chart again. Let's look at an even more recent chart. You still see these same signals appear. So back in February, back in June of this year, there was these engulfing patterns once more to the downside. And you can see that gold has even fallen further from that level of 1240, 1250. That it has still pressed lower. So we need to see a break back through that level. We need to see a breakthrough back that level. We need to see a breakthrough back that level in order to get any way bullish at any point in the future. But it's something which we will be progressing with as we continue through this webinar series. So, the point of these Japanese candlesticks is that they do provide us with a guide. They do shed light on potential opportunities. They're interpretive. They're not crystal balls. And if you're totally new to trading, this evening may be a little bit confusing. But guys, the truth is that this is your opportunity to go out and truly learn this subject matter. Watching the lesson again, asking our support team a question, it'll genuinely help you to understand the subject. Many of you are looking to achieve quite a lot from your trading. You've got to put in something as well. You don't just get great results from nothing. Now, we asked you before about making decisions, and during the first and second classes we looked at charts for you to examine. And with this newfound knowledge, let's examine this again. So here we have a reasonably current, it was taken yesterday, here we have a current FTSE chart, a UK 100 chart. So by looking at this right here, right now, can you make a decision as to what you might do? So please type in long if you would go long at this point. Type in short if you would go short at this point. And type in anything else if there's something else which you might do. So what do you guys think right here, right now for FTSE? Would you go long? Would you go short? Or would you do something else? What would you feel is the best thing for you to do? What do you think? Okay, so I'm going to give you 5 more seconds to type in your answer, and then I'm going to show you a new chart. So here we go. Here is a new chart with just a simple piece of technical analysis applied. So with these lines in place, does this change your opinion? Does this sway you in a different direction? I have a green line which shows a point, what we call support, a point at which the price has been unable to break down through. So we have support to the lower end on this green line. And this red line running through, that was a point of support on one occasion. You can say 2, 3, 4. Support was broken, and what was once support now becomes resistance. So it might prove to be resistant on a journey back up again. So now you have a point of support on a green line. You have a point of resistance on a red line. Do you feel you would change your mind? Would you go short if you had decided to go long, or would you go long if you had decided to go short, guys? What do you think? Do you feel that it's provided you with a bit more clarity? Do you feel that you're able to make a more educated decision as to exactly what you might actually do? Can you see that, by providing just the most smallest part of technical analysis, that it opens up the chart for you, that it allows you to see things in much clearer detail, much, much clearer. And that is what technical analysis is all about. And it's drawing these lines, it's spotting points of resistance, spotting points of support, and then putting them all together with our dojis, with our different types of candlesticks, with different types of patterns. That's exactly what we're going to be doing over the next few classes. So we certainly look forward to welcoming you back to those classes on technical analysis. So in conclusion, from this evening's lesson, you do need to understand your opponent in order to find opportunities in the market. And separating yourself out from your opponent is absolutely crucial. So the next steps in your education is to continue to attend these live lessons. Do continue to attend these live sessions. The next session is in 2 days' time. It's a hugely important lesson where you're going to get a better feel for the likes of the Aussie US dollar chart, the likes of the gold chart, where we're going to be looking at finding opportunities. It's a crucial webinar. Do try to also access the recordings. If you're totally new to trading, do check out this webinar again to make sure that you are comfortable with what we covered this evening. Guys, it brings us to the end of this evening's lesson. It's time now to pause for just 2 moments, and then we're going to go through every single one of your questions. So type in anything which comes to mind, guys, and I'll be back in just 2 moments to go through each of them. Many thanks. Okay, guys, let's start working our way down through these questions. All right, so Andrew, you're saying, can you clarify the hammer candlestick notes the downtrend being bullish? What am I missing? Yeah, Andrew, I do understand. It's a little bit confusing. I'll tell you what, I'll draw it out a little bit for you if I can. So imagine we have a hammer. Okay, imagine we have a hammer, very, very, very crudely drawn. Something along the lines of that. So there's our hammer. So what we say is that if it occurs in a downtrend, so if the market had been trending down and down and down and down, and we saw this hammer appear, then we say that it's a bullish signal, or it has the potential to be a bullish signal. So the likelihood of it reversing might be higher than the likelihood of the trend continuing down. So that's what we mean, that it's bullish in a downtrend. A downtrend is occurring, a hammer is formed. The potential is for it to hammer out a bottom at that point and for it then to reverse and move back up. So hopefully it's a little clearer now. Okay, Yi Yang, you're saying what is bullish and bearish? What do they mean? Bullish is increasing pattern and bearish is decreasing pattern. I guess in essence, absolutely, Yi Yang. A bullish move is an optimistic move, or a move which the price is increasing. So a chart would be going from the bottom left to the top right. A bearish pattern is one where the price is decreasing, where people are pessimistic about that particular market. And again, it's where the chart would be going from the top left to the bottom right. Brent, you're asking about the conclusion of the last chart. Was it long or short? I guess the point was, Brent, that in each instance, for starters, we'd wait for confirmation. That I would wait for a break of either the resistance line to the top side or the supportive line to the bottom side and then decide. I would also have orders placed in both directions in order to take advantage whichever move was to occur. But this is something, Brent, which we'll be going through in particular over the class in 2 days' time, and again the class next Tuesday. Okay, so let me have a look. Eileen, you're asking, why would you want to be a bear and lose on a market? I think if I understand you correctly, Eileen, I think shorting a market or selling a market or having a bearish perspective, I think it's sometimes maybe a little bit frightening for people in a way. That it's a side of the market where not many people have the confidence to trade. And it might be down to the fact that most traders, they tend to be natural optimists. That they tend to take long trades or bullish trades more often than not. But it is a case, I guess, where definitely the quicker profits are made in falling markets, because markets which are falling, they fall or they move much, much quicker than markets which are rising, simply because of the kind of panic which ensues. But we would absolutely favor either direction, Eileen. And I know that sounds a little bit contradictory. How can you favor both? But we treat them both equally. If a short position presents itself, we have absolutely no hesitation in taking it. If a long position presents itself, again, we have absolutely no hesitation in taking it. So it's about analyzing the market and being happy to trade either way. Okay. Chow, you're asking about New Zealand exchange. You'll be able to find that on some platforms. It wouldn't be massively popular, I'm afraid, and running the risk of insulting a lot of people from New Zealand who might be on this webinar. But I guess, you know what, I kind of compare it to a certain degree, and again, I hope it isn't a huge insult, but it's compare it to some degree maybe like Ireland. You know, a lot of people come on and ask for the Irish Stock Exchange. You want to trade that. And unfortunately, it simply isn't popular enough in order for most brokers to justify having those prices available. That the FTSE, the UK market, is one which would be obviously of more interest. And it's a bit maybe like that New Zealand, Australia divide as well, if you like. That there would be possibly more interest by people to trade the Australian exchange than there would be to trade the New Zealand exchange. I hope I'm not insulting anybody, because I think as an Irish person I can feel your pain. Okay, Rami, you're asking how to draw the support and resistance line. We're going to cover that in much more detail during lesson 7, our midweek class. So don't forget that next week there are 3 classes. Lesson 7 is obviously a midweek class. It's an extra bonus class thrown in where we show you how to access a practice trading platform, and we'll also show you how to draw support and resistance lines. Okay, Gavin, you're asking if I can explain resistance and support lines again in more detail and what it means when the market breaks these lines. Gavin, if you don't mind, I'll leave it until the next class, because that specifically, I guess, is what we're going to cover in lesson number 5 and lesson number 6. So we're going to go into that support and resistance and the opportunity which present themselves by analysing market from that floor or supportive or ceiling or resistance nature. It's something we're going to look at a lot more. Okay, what else have we got? Joseph, you're asking what's the point of investing twice in long and once in short if the market looks bullish? Why not just go once in long if it looks like the market is bullish? Joseph, again, I want to maybe show clearer examples. So there's no point in me maybe orally explaining why we do things like that, where I prefer to visually show you why we do things like that actually on a chart. So I think it's incredibly important, Joseph, for you to attend the next few classes to make sure that you get a full answer for that, if that's okay. Okay. Tees, you're saying that technical analysis is really useful, but it does not give any info about present occurrences that might influence the market, say war or natural catastrophes, etc. So just lying on TA isn't that dangerous. I guess, honestly, Thies, I don't believe that it is. I think no matter what happens, or no matter what method you use to analyze a market, whether it's technical analysis or even fundamental analysis, that you cannot allow for something like a war or a natural catastrophe or something like that. Events absolutely occur. Events absolutely occur. World-changing events, events which you would tell your grandkids about, and they will happen throughout your trading career if it is something that you're hoping to progress with. But you cannot allow for them. You cannot predict them. Nobody knows when they're going to happen, no matter what way you analyze the market. But all you can do in order to combat them is to make sure that your risk management procedure is absolutely correct. And that's something which we're going to be going into in a lot more detail as we progress, specifically, I guess, into lesson number 9, which is dedicated completely to risk management. Excuse me. Paolo, you're saying, is there any market that reading dojis are most effective for results, or all markets equally need dojis? Paolo, it's a great question. I think if you don't mind, I'll answer it with a bit of a joke, okay? It's probably the worst joke that anybody in this webinar is ever likely to hear. But it's a good example, I guess. It's a good analogy, all right? I'll put it maybe in a little bit of perspective first. When I'm trading, I honestly don't care. I couldn't care less what the market is. If somebody shows me a chart, the last thing I look at, I'll never ask them, okay, what is this chart of? Because I don't care. When you're looking at it from a technical perspective, all I'm looking for are dojis. All I'm looking for are areas of interest, or magnified areas, or spotlight areas for me to look at. And anyway, without any further ado, the joke is that there was a trader at a specific firm, and week after week, month after month, year after year, he was consistently the best trader of his department. And he kept getting employee of the week and employee of the month and employee of the year. And one day the CEO, he heard of this guy and he said, okay, I've got to go down and meet this guy. So he goes down and says, okay, let's call him, okay, Paolo, you asked the question, let's call him Paolo. So he says, okay, Paolo, you've been a phenomenal employee, you've had the best results over the past number of years, you're a credit to the company, do you mind me asking what exactly you're looking at now? And Paolo says, okay, yeah, absolutely, I'm looking at Ford at the moment. I think I have a long position in Ford, I like them. And the chairman says, oh, that's brilliant, Ford, I love them, I drive Fords, I've always driven Fords, my wife drives a Ford, my children drive Fords, my dad had a Ford before me. I think they're a phenomenal company. I love their cars. I think they really are a good way to go. I can see why you bought them. And Paolo turns around and says, gosh, I didn't even know they made cars. So that, as weak as it is as a joke, I think it is genuinely a great example as technical analysis in action. I really don't care what a market is. I'm only concerned about what it's actually doing, what the price is doing right here, right now. So hopefully that helps, Paolo. Hopefully that helps. Okay, so what else have we got? Recommended books to read on technical analysis, Prakesh. You know what, Prakesh? I'm in fear of recommending books on technical analysis because some of them go into so much detail that is beyond even some of my own capabilities. I fear that many people would get absolutely lost. Look, genuinely, I guess, when we cover throughout the Foundation Trading Program, I think the technical analysis which we show you through is more than sufficient for anybody who wants to trade profitably for the rest of their lives, to be honest with you. But look, if it is something you want to look at, there isn't a bad one. Technical Analysis by John J. Murphy. Technical Analysis of the Financial Markets by John J. Murphy. But I will put in the caveat that it is very heavy going, and it's not something which, needs to be adhered to the letter of the law by somebody who's just hoping to trade on a kind of a part-time basis for that 30 to 60 minutes per day. So hopefully that helps. Okay, what else have we got? Okay, I think that's about it, guys. I think that's about it. Look, we finished our first class on technical analysis. We feel that technical analysis is so important that we dedicate at least 4 classes to it. So we do look forward to having you back in 2 days' time. Between this and then, if you do have any queries at any point, you are absolutely more than welcome to get in touch with any of us here in the Academy of Financial Trading. We'll be more than happy to help in any instance. But until we speak again later later in the week. I wish you all a very good evening. Take care for now. Bye bye.